Right now, I mean, it kind of feels like the world is on fire, doesn't it? You look around, you see oil shocks, stubborn inflation, and everyday people genuinely worried about their jobs, making rent, or just covering the rising cost of groceries at the checkout line. There is this persistent, heavy anxiety that the global economy might be falling apart. But then you pull up the financial news, and what do you see? The stock market is hitting all-time highs, green across the board. It is a massive, jarring disconnect. So what is actually happening here? Well, welcome to this explainer. Today, we're going to figure out exactly why stocks are completely defying the chaos. Okay, let's dive into this, because looking at this massive disconnect naturally begs a pretty simple question. Is the stock market just one giant casino? Well, the answer is actually kind of yes, but definitely not in the way most people think. It's not just blind roulette or throwing darts at a board. There are incredibly specific, deeply structural reasons why Wall Street thrives while Main Street struggles. And to really understand it, we have to completely unlearn a fundamental myth we've all been taught about how the economy works. You see, the absolute biggest mistake people make is assuming the stock market is just a simple scoreboard for the everyday economy. The assumed logic is pretty straightforward, right? If the world is calm and people are spending money, companies grow and stocks go up. And if the world is chaotic and businesses struggle, stocks go down. It sounds totally logical. But the reality, the market is absolutely not a happiness meter for everyday life. The real market is actually a cold, highly calculated machine that prices completely different metrics. To peel back the layers of this financial mystery, we really need to look under the hood at the pricing machine's four core drivers. It turns out the market practically only cares about these four things: future profits, interest rates, capital flow, and forced mechanical trading. Once you grasp these, seeing stock market all-time highs right in the middle of a chaotic world stops looking like magic. Instead, it starts looking highly mechanical, and honestly, perhaps a little bit disturbing. Let's break these down, starting with the first piece, the companies themselves. And this brilliantly illustrates a massive point. The stock market is not the entire economy. It's mostly just a collection of really big public companies. And looking at the S&P 500, it is not evenly spread out at all. A tiny, tiny handful of giant mega-cap companies make up a massive share of the entire index. So when you hear the S&P 500 just hit a record high, it definitely doesn't mean the local businesses in your town are booming. It might just mean the absolute biggest tech companies in the index are raking in enormous profits, even while your own wages feel completely stagnant. The market is really just a scoreboard for the powerful companies that dominate it. There's a second psychological driver at play here too, and it is all about expectations versus reality. Think about this test grade analogy. Imagine bracing yourself for an absolute total disaster, like you are fully expecting a D- on a major test. But then you get a C. Suddenly, that C feels like a massive win. Wall Street works the exact same way. Markets price in expectations. If an earnings report is bad, but hey, it's not quite as bad as the analysts modeled, the stock surges. The actual priced-in risk matters significantly more than the absolute objective truth of the situation. Which brings us to an incredibly important quote to remember as you follow the financial news. Markets don't always rally because the news is good. Sometimes they rally because the news is just less terrible than people feared. If investors are sweating over a worst-case scenario, say oil prices exploding or global trade routes completely shutting down, even a tiny reduction in that fear can make stocks jump. For instance, a simple tweet from a politician hinting at a potential ceasefire can cause markets to rally. Not because the world is suddenly perfect, but simply because the catastrophic risk was just priced out of the machine. Now, let's pivot for a second and transition to our next core driver, interest rates and liquidity. If we look back at the post-2008 financial crisis, and then again during the COVID-19 pandemic lows, central banks aggressively cut interest rates to near zero. Why? Well, to stop the economy from completely crashing. But here's the catch. When money is virtually free to borrow, and keeping your cash in a savings account earns you literally nothing, investors are practically forced to take their money out of the bank. They have to buy riskier assets like stocks, real estate, or even random internet coins just to find a return. But wait, rates are much higher today, right? So the old cheap money rule doesn't fully explain today's market highs. To understand that, we have to look at government debt. $39 trillion. Take a second and just process the sheer scale of that number. That is the current estimated United States government debt. During crises, governments spend absolutely massive amounts of money to keep the economy afloat, and this ongoing deficit spending acts like a giant liquidity pump. It keeps capital aggressively flowing through the financial system, completely overriding the drag of the higher interest rates we have right now. And to carry that enormous debt burden, the U.S. government is currently paying roughly $3 billion a day, just in interest. They aren't paying down the principal debt. That's just the cost of carrying it. Think about where that $3 billion a day actually goes. It flows right out of the government and directly into the hands of the individuals and institutions holding those bonds. It is quite literally a daily injection of fresh capital right into the financial ecosystem.
Now, what's really interesting about this is how that money travels once it's out there. When crisis stimulus reaches regular, everyday people, it circulates in the real economy. It gets spent on rent, groceries, fixing the car. But when extra money ends up with wealthy institutions, they don't go out and buy more groceries, right? They buy assets. They buy stocks, property, and bonds. And this creates a massive surge in demand for financial assets, which inevitably pushes stock prices higher and higher. That dynamic brings us to a really fascinating number, 53. You'll often hear politicians point to the market hitting 53 all-time record highs in a single year as definitive proof of a thriving, booming everyday economy. But if we look at it structurally, neutrally, it's really just a mathematical reflection of intense wealth accumulation at the top. The massive demand for assets among the wealthy is exactly what's pushing the scoreboard to these new heights. So the crucial point we need to take away here is that the pandemic era and its immediate aftermath represent the single biggest wealth transfer in history. More extra money accumulating at the top means the demand for assets rises. If you already own lots of assets, like a stock portfolio or real estate, these rising prices make you significantly richer on paper. But if you're a regular person who doesn't own assets yet, these rapidly rising prices just make it that much harder to ever catch up or buy in. The ladder gets pulled up. And this divide is accelerating rapidly because of a growing flight from cash. Simply put, people are losing trust in fiat currency. When governments constantly print money to manage crises and carry massive debt, the cash everyone holds naturally loses its purchasing power to inflation. It's like holding a melting ice cube. So what do smart investors do? They defensively park their wealth in hard assets. They move money out of cash and into stocks, housing, gold, and Bitcoin, just to escape devaluation, which, you guessed it, further drives up the stock market. Okay, up until now, we've talked mostly about the macro economy, but there is a hidden high-speed layer to this machine, Wall Street's mechanical trading. To grasp it, we have to look at something called a call option. In simple terms, it's basically a leveraged bet, a financial contract that a specific stock's price will go up. Traders use these to multiply their potential returns. And this specific instrument triggers something absolutely wild in the modern stock market. Let's move to the mechanics and see how this builds, creating what we call the algorithmic amplifier. Most financial news barely mentions this, but a huge chunk of trading today is done automatically by algorithms. They aren't sitting there debating geopolitics, they just follow price trends. Here's how it goes. Step 1. A little bit of less terrible news makes the trend flip up. Step 2. Algorithms instantly auto-buy. Step 3. Human traders pile into call options, which actually forces the big firms who sold those options to go out and buy the actual underlying stock just to hedge their own risk. Step 4. All this buying feeds on itself. It creates a robotic feedback loop that amplifies a tiny, insignificant rally into a massive, record-breaking high. I know we just covered some really intense financial mechanics there, from options hedging to algorithmic feedback loops. If you want to confidently navigate Wall Street jargon without getting totally lost in the weeds, there is a completely free cheat sheet linked in the description below. It is an absolutely incredible tool for making sense of daily market news and understanding the real mechanics hidden behind the headlines. Definitely check that out. Which brings us to our final thought. We've seen today how the stock market isn't a reflection of your grocery bill, but a highly complex machine driven by concentrated profits, massive government debt, asset hoarding, and robotic trading loops. But look, the market can't rise exponentially forever. Eventually, something has to give. As this explainer wraps up, the real question we have to ask ourselves isn't just why are stocks going up, but who actually benefits when they do. As asset prices accelerate and wealth inequality widens, what is the real-world cost of Wall Street's record highs? I'll leave you to ponder that. Thanks for joining me on this explainer, and remember to always keep questioning the numbers you see on the screen.